Hello and welcome to preparation of financial statement series. In this session, we will prepare the financial statement for the given information and also try to understand the concept of deferred taxation here. So as usual, set of transaction with opening balance sheet given, and we'll use this data to prepare the financial statements. Sold 50% of the goods, so 50% of the goods is 75,000 of 50% of goods 0.50 were sold for 200,000 and entire sales is for cash. And that leads to the reduction of stock. The stock reduces by 75,000. Purchase a plant acquired for 100,000, and so plant is an asset, will appear on the balance sheet. The depreciation on plant is 25% on SLM, so 0.20. This is, we can take here, plant depreciation is into 0.25, so depreciation is equal to 25,000, so accumulated depreciation will appear on the balance sheet as -25. Dividend received is 25,000, and dividend is also a cash inflow, so and dividend will be shown in the income statement and cash flow statement. Interest for the time period is 9%, 0.09, and let us assume that we pay the interest, so interest is equal to 17,100. So since all the expenses have been taken care, we can find the PBT. So PBT is equal to income minus expenses, so 225 minus 117,100. But before we calculate the tax here, since the tax related information is given that some incomes are not taxable, some expenses are allowed in a different manner, it is necessary to prepare the tax statement. So the tax statement, the sales is same as the accounting. Dividend is not taxable. Dividend is not taxable, so 0. Expenses is COGS is same as accounting. The interest is same as accounting, but depreciation, it says 50% on RBM, so 50% on 0.50 on 100,000, so depreciation is 50,000 in taxation, whereas 25,000 in accounting. So the tax payable, taxable income, so taxable income is 57,000. Taxable income or taxable profit is equal to 57,900. so if the accounting profit is not same as tax profit, according to the accounting standard we have to show the current tax, and the current tax is on the taxable income. Along with that, it is necessary to show the deferred tax, and the deferred tax is the tax on the timing difference, 50,000 minus 25,000. So deferred tax is the tax on the timing difference, and the deferred tax is calculated in this case as 30% on the difference between the taxable expenses and the accounting expenses. In this case, only depreciation is different in taxation and accounting. So therefore, the timing difference arises only because of depreciation. The CT, it says that the company has not paid the tax, so will not pay the tax. So as a result, the tax payable, CT payable, will become a liability. If the tax expense is greater than the CT, then there is a deferred tax liability will appear on the balance sheet. So deferred tax liability will appear on the balance sheet, and deferred tax liability in this case is 7,500. 7,500 is a tax on the timing difference, and the timing difference is the depreciation. Now we can find the PBT minus tax expense will give us PAT, and the entire PAT will be transferred to the retained profit. We can find now the cash available. Cash available is equal to cash in hand is equal to cash available minus the cash expenses, cash payments. So 278,000 will be transferred to the balance sheet. No change in the capital, no change in the loan, no change in the creditor. So the summation of this will give us the sources. No change in the debtor, no change in shares. So the summation of the source assets is equal to the summation of the sources. So the equity has gone up. Equity has gone up because the reserves have gone up. Reserves have gone up because of the current profit fully retained. Now observe this depreciation and the deferred tax. In this case, deferred tax arises is because of the depreciation. Now let us take the T2, year 2 now. We'll do the year 2 with the same assumptions, except that the plant is not, has been purchased only in the first year. So opening cash in hand will become 278. So same sales, same dividend, and let us assume that the sales is also received and dividend is also received. An entire balance stock sold in the second year. Interest is same. So the expenses in the second year is 225. Depreciation in the second year will also be 25,000 for accounting. So the total expenses for accounting is same, and the PBT is 107,900. But what about the tax sheet? The tax sheet will show the sales to be 200,000, dividend to be 0, COGS is same, and interest is same, but depreciation is 25,000 because depreciation is charged on the reducing balance method. So the taxable income is 82,900. So the current tax will be tax on 82,900, and the deferred tax will be 0 because there is no timing difference. Depreciation accounting is same as depreciation in taxation, and since we are assuming the tax has not been paid, so this current tax payable will further increase, and deferred tax liability will continue to appear as long as the asset on which the deferred tax or depreciation difference arises. So deferred tax liability stays at 7,500. So cash in hand in this case is except the interest being paid. So cash in hand is 486,300. So cash in hand will appear on the balance sheet now, and the PAT will be transferred to the retained profit. Entire PAT will be transferred to the retained profit. No change in the capital, no change in loans, no change in creditor. The summation of this will give us the total sources. No change in the debtor, no change in the stock has reduced. That means we sold the entire stock. No change in shares. The plant value remains same. The depreciation goes up. Accumulated depreciation goes up to the extent of 25,000 and the balance sheet tally. But observe this deferred taxation. So deferred tax is the tax on the timing difference. In the first year there is a timing difference of 50 minus 25, and that appears as the deferred tax liability. In the second year there is no deferred tax because there is no timing difference. However, DTL continue to appear as long as the plant continues. Thank you very much.